Right now, everyone's blaming inflation on the Middle East. That's the narrative we've been handed, and everyone's accepted it because it makes sense. It's easy to follow. Clean cause, clean effect. Simple enough to sketch on a napkin. Except there's one problem with that story. The Federal Reserve keeps its own inflation scoreboard. They don't use the number that shows up in the headlines. They target 2% inflation measured by personal consumption expenditures, the PCE. That's the number that actually counts. And it's also where the mainstream story falls apart. The conflict in the Middle East started just 5 months ago, but the Fed's preferred measure has missed its target for 63 straight months, more than 5 years running. The PCE currently sits above 4%, more than double the Fed's target, and it's still climbing. So everyone's using a 5-month-old story to explain a 5-year-old problem. And this isn't some number that only matters to economists. It sits underneath almost every financial decision made in this country. Every rate you pay is priced off what people expect that number to be, your mortgage, your car loan, what your savings account earns, what the cash in your wallet will be worth next year. So it's worth asking what's actually going on, because there's clearly more to this story. A pendulum that used to swing back. Inflation in America used to move like a pendulum, swinging up, swinging back down, settling near that 2% mark. You never had to question it. Economists even gave that era a name, the Great Moderation. From 1985 to 2007, growth was steady, inflation was low, and the economy looked almost self-regulating. Except it wasn't. There was no invisible hand. There was a real one. Someone was standing beside that pendulum, pushing it back toward the middle every time it swung too far. It happened so reliably for so long that people forgot the pendulum was ever being pushed at all. That's what the last 5 years are really about. The thing doing the pushing is now in trouble. But before we get there, we need to look at that 2% target itself. Where did 2% even come from? For a number the entire financial system is anchored to, you'd assume it came from some deeply complex formula, or that it was handed down as some kind of economic law. It wasn't. Someone simply chose it. Here's St. Louis Fed economist Christopher Neely explaining how central banks landed on 2%. In short, policymakers were weighing the cost of inflation against the benefits of a little upward price movement, which gives central banks room to stabilize the economy. 2% became the happy medium. So while the number itself was somewhat arbitrary, there's real logic behind it. Why not just aim for 0? That's the obvious next question. If inflation quietly makes everything more expensive, why target any of it? Because a 0% inflation world sounds great on paper, but falls apart in practice. When a recession hits, the Fed's main tool is cutting interest rates. In a zero inflation world, rates are already sitting near the floor. So the moment a real downturn arrives, the Fed gets one cut, maybe two, and then hits 0 structurally out of room. That's how an ordinary recession can spiral into a decade-long depression. But you can't aim too high either. Push inflation to 4%, and prices double every 18 years. Businesses can't forecast costs, and nobody can price a long-term contract without guessing. So 2% became the Goldilocks number, high enough to leave a cushion against catastrophe, low enough that you barely notice it on an ordinary Tuesday. Actually hitting that number year after year is an incredibly difficult balancing act, and for decades the Fed made it look effortless. We're only now finding out how much of that ease was borrowed. When the tightrope was only 6 inches off the ground for decades, the walk toward 2% looked effortless, but only because the tightrope was 6 inches off the ground. We only know that because we've since seen what the same walk looks like 60 feet up. But before the ugly part, here's the good part, a time when the Fed still had room to work with. Volcker shock therapy rewind to the late 1970s. Inflation wasn't drifting anymore, it was sprinting, peaking above 13.5%. At that pace, prices double roughly every 9 years. The dollar in your pocket was losing value while you held it, and everyone could feel it. Enter Paul Volcker, who became Fed chair in 1979 and did what no one else had the stomach for. He drove interest rates to 20%, deliberately triggering back-to-back recessions to strangle the money supply until inflation had nothing left to feed on. It became known as the Volcker shock, and it worked. Inflation fell from over 13.5% to under 2% by the late 1980s. From 1980 to 1983, Volcker tightened aggressively, triggered 2 recessions, and cut inflation by more than 10 points. 2 years later, the U.S. entered the Great Moderation, a 23-year stretch of steady growth and historically low volatility. Which raises the obvious question. If it worked for Volcker, why can't the Fed just run the same playbook today? The advantage Volcker had that we don't. Because Volcker had one advantage nobody talks about. The country could absorb the damage. When he took over, national debt was about a quarter the size of the economy, small by today's standards. So when he pushed rates to 20%, it was brutal, but clean. Raising rates did exactly what he intended. It slammed the brakes. That world is gone. National debt now sits around 100% of GDP, roughly matching the entire economy. The last time it was this high was World War II, but the size of the debt is only half the problem. What that debt does is the other half. When the Fed raises rates today, it presses down in two places at once. The first is the brakes. Higher rates, pricier loans, less borrowing, a slower economy. Simple enough. The second is hidden, and it emerges almost by accident. Higher rates also mean the government pays more interest on what it already owes, and that bill isn't small. Net interest is running around $1 trillion a year, more than the entire military budget. In 2021, interest ate about 9% of every dollar the federal government collected. This year, it's 19%. Those interest payments don't vanish. They land in the hands of pension funds, banks, foreign governments, and other investors who lent the U.S. money in the first place. So every time the Fed raises rates to cool the economy, it also increases the size of the check it has to write, money that gets spent, lent out, or rolled into the next bond at an even higher rate. The same move, meant to pull money out of the economy, ends up quietly sending some of it back in. One foot presses the brake, the other quietly presses the gas. And the heavier the debt, the harder that second foot pushes. At 25% of GDP, you barely feel it. At 100%, both pedals are floored, and the brake is wired to the accelerator. The 1981 Warning to Economists saw this coming in 1981. Thomas Sargent and Neil Wallace in one of the most influential macroeconomics papers of the last 50 years. Their warning, in plain terms, if the government never runs a surplus, the central bank can't actually shrink the debt. All it gets to decide is what form the debt takes, bonds or cash. So when the Fed fights inflation, it's squeezing the cash side, which means the bond side has to grow to make up the difference. And bonds pay interest. The longer the Fed holds the line, the faster that debt compounds. So the tightening that brings inflation down today is the same force that eventually requires someone to print more money later. The Fed isn't solving the root problem, it's postponing it. If that sounds like an old academic theory with no bearing today, consider this. New Fed Chair Kevin Warsh recently launched 5 task forces to tackle different economic problems. One is an inflation frameworks task force, reassessing how the Fed measures and responds to structural drivers of inflation. One of the 3 people chosen to lead it, Thomas Sargent, the same economist who co-authored that warning 45 years ago. The ground moves last inflation is clearly still a concern inside the Fed, but step outside and it feels quiet. Gas got cheaper last month. Headlines say things are cooling. You might think this has already sorted itself out. But the thing people forget, the ground is always the last thing to shake. By the time you feel an earthquake under your feet, the fault line slipped a while ago. The impact is already on its way. The inflation numbers in the headlines are that ground. They move last. Housing is the clearest example. It makes up more than 35% of the basket behind the headline number, and it's the slowest moving piece in it, since rents lock in for a year and reset in steps. So a big chunk of today's reading is measuring pressure that was released months ago. When the headlines say, everything's calm, they're really telling you the ground held yesterday. Waiting on the inflation number means finding out last. You have to work backward to get to the truth. Follow the money, literally strip everything away, and inflation is one thing. Prices going up. But a price only rises if someone actually pays the higher one, and nobody pays more without having more to pay with. So the money moves first, every time. There's a number that tracks exactly that. 2, one of the main measures of how much money is circulating through the economy. After 2020, that line goes almost vertical. M2 is currently growing at over 5.5% a year, the fastest pace since July 2022. But money doesn't appear on its own. Someone has to put it there. So if inflation is the enemy, who's quietly pumping fresh dollars back into the system? The answer, the Federal Reserve, the tool hidden in the back of the closet. To understand how, set interest rates aside for a second. There's a second lever, one that only comes out in emergencies. It's essentially a money printer. When the economy is collapsing, like in 2020, the Fed creates money and uses it to buy bonds, pushing new money into the system to keep things alive. That flood of new money is called quantitative easing, and during the pandemic, the Fed ran it harder than at any point in history. Its balance sheet went from around $4 trillion to nearly $9 trillion in about 2 years. And inflation eventually spiked above 9% in June 2022. When inflation caught fire, the Fed did something it had only done twice in its history. It ran the printer in reverse. Instead of buying more bonds, it let existing bonds expire without replacing them, a little less money in the system every month. This is called quantitative tightening, and it began in June 2022. Over the following 3.5 years, the Fed pulled more than $2.2 trillion off its balance sheet. It worked well enough that the money supply itself contracted, something that hadn't meaningfully happened since the Great Depression, but you can't tighten forever. The financial system needs a baseline amount of cash to function day to day. Drain past that line, and things start breaking. On December 1st of last year, the Fed announced quantitative tightening was over. They'd unwound roughly half of the more than $5 trillion injected during the pandemic. 11 days later, on December 12th, the Fed started buying bonds again, around $40 billion a month. The balance sheet it spent 3.5 years shrinking is now refilling. Two stories, running at once, so the country is running two very different narratives simultaneously. The first shows up in the monthly headlines, the story everyone argues about, refreshed every 30 days. The second runs underneath it all, the structural story. The Congressional Budget Office now projects this year's deficit at $1.4 trillion, 5.8% of the entire economy, far above the 50-year average, 3.8%. Total national debt is closing in on $40 trillion, and interest payments now exceed $1 trillion a year. In 2021, interest consumed about 9 cents of every federal dollar collected. This year, it's 19 cents, more than double in 5 years. Interest is now the third largest line item in the federal budget, ahead of the entire military. The debt spiral is unfolding almost exactly as Sargent and Wallace predicted more than 4 decades ago, Buffett's 5-minute fix. So how do we actually fix this? One of the sharpest answers comes, unsurprisingly, from Warren Buffett. Asked how he'd handle the deficit, his answer was roughly this: pass a law saying that any time the deficit exceeds 3% of GDP, every sitting member of Congress becomes ineligible for re-election. That, he said, would finally put the incentives in the right place. He was joking when he said it, but he wasn't wrong. This is an incentives problem, not a left or right problem. Both parties do it. Think about how someone actually wins a seat in Congress, by promising to spend on this and that, because that's what gets votes. Nobody builds a career promising people less. So the incentives point in one direction, more spending, which is how the deficit has run past 3% of GDP for nearly the entire 21st century. This isn't a rough couple of years, it's structural. We've spent more than we've collected for roughly a quarter century straight, and the problem compounds. The more we borrow, the more interest we owe. The more interest we owe, the more we have to borrow. It's a self-feeding cycle. We're on a path that isn't sustainable indefinitely, and every year we delay dealing with it, the eventual bill only grows. So the real question, is this something we need to face now, or is it being overblown? Maybe Buffett's plan is too extreme. Maybe it isn't extreme enough. We can debate the right solution all day, but one thing isn't up for debate. This doesn't fix itself. Something eventually has to change.